All right, welcome to Part B of Lecture 36. Got a big one coming up. The Greenspan era, dot-com bubble, housing bubble, financial crisis of 2008, coronavirus panic of 2020. We're going to cover it. We're going to survey it in Part B of this lecture. All right, Alan Greenspan, Fed chairman from 1987 to 2006. Probably the most important Fed chairman in the history of the Federal Reserve, okay? At least the most well-known, and I would argue the most important of the Fed chairman. 19 years, or almost 18 and a half years, he was chairman of the Federal Reserve. Now, you may ask, how was that? Because, governors of the Federal Reserve, they have 14-year long terms. How did he serve 18 and a half years? Well, he completed another governor's term, and then he was able to begin a fresh 14-year long term. Alan Greenspan, a proponent of, well, I think you could say the face of capitalism in the late 20th century. Is that fair to say? The face of capitalism in the late 20th, early 21st century. Alan Greenspan, that's it. Combined an relatively easy money, easy credit policy with financial deregulation, free markets, free trade, international commerce. An example of deregulation that occurred under the Greenspan regime or tenure at the Federal Reserve was the repeal of Glass-Steagall in 1999, which had Glass-Steagall, as you remember, in 1933 had separated commercial banking from investment banking. That was repealed in 1999 under Greenspan's watch. Alan Greenspan back in the 1950s and in the 1960s was a follower of Ayn Rand, and wrote several essays during that period championing objectivism. If you're familiar with the objectivist philosophy at all, one that championed the individual, okay, and put the individual up front, and was unapologetic about the virtue, as Ayn Rand called it, the virtue of selfishness. Alan Greenspan also championed in these essays the gold standard, which was a decidedly minority position by the 1960s. Greenspan abandons that after the 1960s, but retains other elements of that philosophy. He later, before he became Fed chairman, served on J.P. Morgan's board of directors for 10 years. Becomes Fed chairman in August of 1987. And over the next 18 years becomes, frankly, a celebrity. And well-liked, well-respected. I remember at the time, back in 2002, when I was an undergraduate in college, I took a business class, and I remember hearing Greenspan would be name dropped here and there in the class, and he was spoken of almost like a god. It just had so much power over the markets, and he was treated like that in the press and in the journals, and looked up to as the man in control of the lever, and he was. And for an 18-year long period, you could not think of a more powerful figure in the U.S. economy. And I would argue that Greenspan was even more powerful than the President of the United States during this period. You look at it, who really controls what's going on in the markets and in the movement of the economy? President Bill Clinton, George W. Bush, or Alan Greenspan? And the answer was Alan Greenspan. During Greenspan's tenure, the financial industry grew. And the markets grew. And actually, when he leaves office in 2006, he leaves with a lot of fanfare. He's seen as a very successful Fed chairman. His reputation has taken a hit over the last 10 years, as many people have questioned the long-term effect of his policies, especially in light of the financial crisis in 2008. And so opinions are much more mixed on Greenspan today than they were while Greenspan was actually the chairman of the Fed. There's Greenspan a bit later in his tenure in the mid-2000s. So, How does Greenspan run the Fed? Relatively low interest rates. Okay. Now here's a long-term graph. I've made it long-term by way of comparison. This is Volcker. Volcker's tenure ends around here, okay, and then Greenspan takes over. So you can see Greenspan compared to Volcker, substantially lower interest rates. And for much of the 90s, it doesn't really exceed 5%. And in fact, quite frequently dips below 5%. And then especially in the first half of the 2000s, quite low after 2000. You're talking well below 2% or even a point and a half. Here's a more zoomed in graph of Greenspan's tenure. So Greenspan becomes Fed chair here. A little bit of a raising of rates as a result of the stock market dip in 1987, then a lowering of rates in the early 90s, and a lowering of rates in the early 2000s. Nevertheless, inflation is under control under Greenspan. Here's a graph of inflation rates under Greenspan. Never, outside of this short period here in the late 1980s, inflation never exceeds 4% or barely even 3%. So fairly low inflation throughout Greenspan's tenure. And the price of gold was under control during Greenspan's tenure as well. Here we see a bit of a peak at $4.80 an ounce, but through most of the 1990s, an ounce of gold sold between $250 and $350 an ounce. Purchasing power of the U.S. dollar has lost a bit since 1980, but it's not enormous. Relatively stable, but you add that 2, 3, 4% inflation every year, and you have a little bit of decline in the U.S. dollar, but nothing even approaching what you saw in the 1970s. Moreover, the stock market was quite spectacular through much of this period. This is the Dow Jones, and I actually tailored this graph to cover Greenspan's tenure from August of 1987 through January of 2006. And you look at it, when Greenspan became Fed chair, just over 4,000, the Dow. And by the time he leaves, it's at comfortably, above 13,000. Okay, and at one point had hit 18,000. That is a vibrant stock market. Unemployment rate, under control. You saw a bit of a rise here in the early 1990s. There was a slight recession, which contributed to Bill Clinton's victory in the 1992 presidential election. But then, unemployment sitting pretty well here through most of the 90s, below 5%. Takes a bit of a climb here when the dot-com bubble burst. Get to that in a second. In the early 2000s, but begins to go under control again by the mid 2000s. So, Greenspan leaves and it's seen as pretty successful. Nevertheless, you do have some hiccups. You have an early 1990s recession. The economy recovers fairly well. Afterwards, it's kind of a non-event. Has a big political impact in helping Clinton become president, but outside that, a non-event. Nevertheless, there was a major bubble during Greenspan's tenure as Fed chairman, and that was the dot-com bubble. Beginning in 1997, a bubble emerged in the internet sector. This is a new sector in the economy, a very exciting sector. And the price of stocks in so-called dot-coms went through the roof. And many new companies, startups. Here's a graph of the NASDAQ from the mid-90s all the way up to the peak just after 2000. Look at that. That's more than 5 times growth. The NASDAQ is particularly reflective of this dot-com bubble. You had all sorts of new startups, companies we've never heard of since because most of them went under. bubble, bubble, bubble. and of course it burst. In early 2000, the bubble burst. Look at the NASDAQ. Drops from a peak of 5,000 down to below 1,500 by early or by summer of 2002. And the Dow didn't do so well either. Peak of 16,000, dropped down to almost 10,000 by 2002. So, it's a pretty big burst in the bubble. Only 48% of dot-coms survived, so more than half of dot-coms went under. And if you want to take a look at the entire economy as a whole, there was a loss of $5 trillion in the market value of companies. $5 trillion loss in market value of companies. So yeah, that's a pretty big bursting, bubble bursting. And you'll see here, unemployment went from about 4% up to approaching 6%. Okay, and then a little higher than that. So a significant deal, not depression level, but a definite bubble and a definite burst. How does Greenspan respond? Greenspan responds by lowering interest rates. Well, you've got to, Greenspan says. We've got to get that market going again. We got to provide that liquidity. And look at the results. I mean, it goes down 10,000 points by 2002. I remember at the time I was 18 years old and like, oh, is it going to keep going lower? But it didn't. It climbed back up. And by 2006, it's back to 16,000. Well, what was that fueled by? Well, it was fueled in part by low interest rates. Look at what Greenspan does here. This is key, very, very critical. In the early 2000s, the Fed reduces interest rates, the federal funds rate, down to between 1% and 2%. And by 2003, it's hovering at just over 1%. That's extremely low. Those are very, very low interest rates. It succeeds in bringing the Dow back up. It succeeds in causing unemployment to go down a little bit. But what Greenspan does, inadvertently, is he lays the groundwork for a new bubble, right? Look at all this easy credit here. These are very, very low rates, 1% to 2%. Credit is flowing, combined with deregulation, repeal of Glass-Steagall and other measures that deregulated the derivatives markets. And it wasn't just Greenspan. Greenspan works in tandem with Treasury Secretary Robert Rubin and Larry Summers, who were Bill Clinton's Treasury Secretaries in the late 90s, deregulated much of the derivatives markets. Easy credit plus deregulation equals bubble, right? Bubble. Housing bubble, 2004 to 2007. And this is why Greenspan's reputation has taken a bit of a hit, because Greenspan exits before the bubble bursts. He exits actually at the peak of the bubble, but his successor, Ben Bernanke, will have to pick up after him. And one of the features of this housing bubble were so-called mortgage-backed securities and subprime mortgages. These were mortgages that had, on the face of it, a very, very attractive rate of return, right? Because they had a high interest rate. They also had an adjustable rate, meaning the rate could go up if market conditions warranted it. Why did it have a higher interest rate, these subprime mortgages? Well, because there was a lower credit quality. So subprime mortgages were mortgages given to people who had lower credit quality, who wouldn't have qualified necessarily for a loan in previous eras. Between 2004 and 2006, subprime mortgages rose from 8 to 20% of mortgages. 8 to 20% of mortgages, and in some parts of the U.S., it was higher than 20, much higher actually than 20%. Now, again, these had an attractive rate of return, and then mortgage-backed securities were leveraged upon that, based upon those securities, and were owned as assets by many of these financial institutions. And the housing market is going up, 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 up. Now, this is a graph of the median home price in the U.S. between 1951 and 2020. Now, in the blue here, you see the nominal price, but we've had a lot of inflation, so that can only tell us so much. By the way, look at that. You could, in the 1950s, that's pretty wild. You could buy a house, purchase a house for under $25,000. Okay. Now, having $25,000 was a much bigger deal back then. It wasn't just something you could whip out, but that's quite low. So what really counts here is the real, what we call the real price, which is adjusted for inflation. Look at this. Look at that. That's from that movement is all in the late 90s, but really begins to pick up in the early 2000s, and it peaks in 2006. So it ends here. November 2006, we have the peak, the median home price. Alan Greenspan began to sense this housing bubble, and toward the end of his term, Alan Greenspan is out in January of 2006. So Alan Greenspan leaves about here. Okay. Greenspan began to slowly raise rates. Okay, so there are some raising rates after toward the second half of 2004. It's not that much. I mean, it's still, the rates are still pretty low, historically considered. And then Greenspan's out. Bernanke's in. Ben Bernanke, Fed chairman from 2006 to 2014, another very important Fed chairman. Ben Bernanke becomes Fed chair, and the housing market begins to show some signs of weakening. And in early 2007, housing prices began to fall a bit. Bernanke responds to this by cutting interest rates. So this is the beginning of Bernanke's term, tenure as Fed chair, a slight raising of rates in the first half of 2006. It's held fairly constant through the first half of 2007, and then after summer of 2007, we see a fairly rapid reduction in the federal funds rate. By summer of 2008, that's where housing prices are. Okay, by summer of 2008, it's pretty clear this was a housing bubble, and the problem for the financial system is the financial system had all of these mortgage-backed securities that were banking on, speculating essentially on the hope, on the expectation that these housing prices would continue to go up, or at least would remain constant. And now instead they are collapsing. All right. So by summer 2008, the housing market's collapsing. Perhaps this is why Ben Bernanke is trying to prop it up by lowering rates in the first half of 2008. And after summer 2008, that's when the house of cards begins to fall. Lehman Brothers, the fourth largest investment bank in the U.S., collapses, goes under, goes completely bankrupt in September. Lehman Brothers was not bailed out. They just went under, okay? And that was sort of the telltale sign. Whoa, wait, something's happening here. Okay, fourth largest investment bank in the U.S. goes completely under. These were the top three: Goldman Sachs, Morgan Stanley, Merrill Lynch. Merrill Lynch is about to go under. Right at the last minute, Bank of America acquires Merrill Lynch. But the dominoes are falling. Okay, it's pretty darn clear this entire system is collapsing. You'll see here: subprime mortgages, mortgage companies, lenders, home builders, markets, U.S. economy, world economy. Well, there goes the neighborhood. And from October 2008 through February 2009, the stock market completely loses it. Look at this, the peak. So this was the dot-com. This was the dot-com bubble. That's the dot-com burst. This is the stock market in the early to mid 2000s, and then bam, 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 bam. February 2009, the stock market hits 8,000. I remember this very well, and it was a scary time. Like, is this going to completely go under? Are we entering a new Great Depression? Well, George W. Bush is president of the United States. He's in his final months. And he has a Treasury Secretary, Hank Paulson. And Hank Paulson, he's been Treasury Secretary since 2006. Hank Paulson, he knows a bit about finance. Paulson has worked at Goldman Sachs since 1974, and in fact, he was CEO of Goldman Sachs from 1999 through the year 2000. And while he was CEO of Goldman Sachs, made just millions and millions of dollars, obviously. Okay? Now, when he became Treasury Secretary, he was required to liquidate his holdings in Goldman Sachs, because that would be a conflict of interest, and it was $600 million worth. So this is a man in the industry, okay? Hank Paulson swoops in at the peak of this crisis in October 2008 and tells Congress, you have no choice. You've got to step in here and bail out the banks. And so this huge debate erupted. And I remember, many of you remember this as well. Should the government bail out the banks? And Hank Paulson went to Congress and said, you have no choice. If you don't do this, the entire system is going to collapse. And according to one congressman, Brad Sherman, he was told that the fear-mongering on this, maybe it was legit fear-mongering, right? The fear-mongering was so big that a few members of Congress were told, if you don't bail out the banks, there will be martial law in America, because the stock market will crash to almost zero. There will be civil unrest, social unrest in the streets, and the military will have to restore order. Like, and you can look that up. I should have had the video prepared. It's okay, not a big deal. Brad Sherman, look that up. It's crazy stuff. Anyway, huge debate erupt. I remember at the time I actually called my congressman in North Carolina, which is where I was living, and I was like, don't pass this bill, reject this bill, it's a scam. And the Congress passed it. Democrat-controlled Congress, signed into law by Republican President George W. Bush, and Barack Obama, who was in the Senate at the time, who's running for president, but he was in the Senate, also endorsed the bailout. But what was it? A $700 billion bailout of the U.S. financial system. The U.S. Treasury bought toxic assets, okay, especially mortgage-backed securities. What is a toxic asset? Basically, assets that were held by the banks that were junk, okay, total junk, that were based upon just faulty house of cards, nothingness, okay, and the veil had been lifted that these assets were worth nothing. They weren't assets at all, and so that's why these banks and financial institutions were going under. And if the bailout didn't happen, in truth, in fairness to Hank Paulson, it would have liquidated many of these companies, not all of them, but many of them. This was called the troubled asset. That's a nice way to put it. Yeah, troubled asset relief program. Oh, relief program. TARP. Passed the Congress, was signed by the president. Now, even though it allowed for $700 billion, by the end of it, the Treasury dispersed $426 billion, and eventually these financial institutions repaid. So the Treasury got all the money back, but it's extraordinarily controversial. One of the reasons why it was controversial, look at this. These are all the institutions that got TARP money. This is in millions of dollars, millions of dollars. You have Citigroup, all the big banks. Citigroup, $50 billion. Bank of America, $45 billion. AIG, $40 billion. JP Morgan, $25 billion. Wells Fargo, $25 billion. You had some GM. Goldman Sachs, $10 billion. Whoa, wait a second. Oh, right? Seemed to be a lot of conflict of interest here. A lot of conflict of interest in this debate, in this bailout. Again, it was all repaid, but a lot of these companies would have gone under. Not all of them, but a lot of them. Moreover, the new Treasury Secretary who oversaw the disbursement of many of these TARP funds under President Obama, who became president in January of 2009, was Timothy Geithner. Now, Timothy Geithner was the president of the Federal Reserve Bank of New York from 2003 to 2009. And while he was the president of the New York Fed, he came very close to many of the Wall Street banks and hedge funds, and was on record dining regularly with senior executives from Citigroup, Goldman Sachs, Morgan Stanley. Jamie Dimon, he was very close to. Jamie Dimon, who was and is the CEO of JP Morgan Chase. Jamie Dimon was also a member of the New York Federal Reserve Board. And actually, while Geithner was head of the Federal Reserve Bank in New York, he was even approached by Citigroup about the possibility of becoming CEO. And anyway, a lot of just things that rub people the wrong way, okay? Rub people the wrong way. Probably the most infamous, notorious controversy was the bonus payments that AIG paid out after receiving bailout money. So AIG was the American International Group. It was a finance and insurance corporation. And as you can see here from the chart, they received $40 billion of TARP funds. So the taxpayer bailed them out $40 billion. In 2008, AIG had posted a $62 billion loss. $62 billion loss, bailed out by the taxpayer, $40 billion. Nevertheless, in March of 2009, AIG paid out bonuses to their employees of $218 million. $218 million bonuses to their top employees. Man. Woo! Oh man. That was a bit of a controversy, if y'all remember that, back in 2009 when that happened. And they weren't the only ones, to be fair. I mean, a lot of these firms paid out bonuses in 2009 despite taking taxpayer money. So, now, did it succeed? That was the stock market. Okay, look at unemployment. Unemployment went up a lot. Unemployment was under 5%. Look at that. Bam. By spring of 2009, and by summer 2009, it's hit double digits. Double-digit unemployment. How does Bernanke respond? Remember, Benjamin Bernanke is the chairman of the Federal Reserve. Cuts rates. Okay, cuts rates. Now, he had already started this, as I noted before, in order to prop up the system. Didn't work. Still collapsed anyway. Had to bail it out. But look at that. Oh, man. From early 2009 through the rest of his term, which ended in 2014, near zero interest rates. And it wasn't just TARP that was giving money to the banks. It was also the Federal Reserve. Because to maintain these low interest rates, the Fed is buying securities, working on the open market operations, and quantitative easing. And so, and we don't know because the Federal Reserve isn't audited. Audit the Fed. I'll make a video about that later. Federal Reserve isn't audited, so we don't know exactly what the Fed does in its open market operations. What we do know is that the big firms received a lot of money, not just from TARP, but also from the Federal Reserve. Okay, but look at that; those are very, very low interest rates. Now, Bernanke's defense. You want to hear Bernanke's defense? Look at the stock market. Look at the stock market. There's the low point, early 2009. Bam! Went right back up by 2013, 2014. It's where it was in 2007. 2007. All right, so stock market recovers. What about inflation? What about inflation? Oh, actually, not so bad. Look at that. Look at that. Actually, a little bit of deflation in early 2009. But look at that. Not bad. Under 3%, and for part of Bernanke's tenure, under 2%. Bernanke actually argued that maybe he's been too hawkish on monetary expansion. I remember at that time, and I was one of them. You looked at these low interest rates; these are going to be major inflation in the value of the U.S. dollar, and it didn't happen. The U.S. dollar did not hyperinflate, like many, including yours truly, to be fair, thought might happen. Inflation remained under control. Now the price of gold went up a lot. Look at the price of gold. Just under $600 an ounce in 2006. By 2008, it was approaching $1,000, and fell down to about $700 an ounce in late 2008. And then look at that, bam! By 2012, we're looking at like $1,600 to $1,800 an ounce. That's a big increase in the price of gold. What about unemployment? How does Bernanke and the Fed do here? Well, that's pretty bad. Okay, so there's the Dow. Hey, that's good for your 401k. Unemployment, though, remained between 2009 and 2012 was over 9%. Okay, flirting with double digits. That's quite a long time through the end of 2011. Housing market falls even further, hits its low point by summer of 2011, but it needed to. Housing prices were inflated. Then after 2012, things begin to stabilize, okay? And unemployment falls. By the end of Bernanke's term, unemployment sits below 7%, okay? Below 7%. And by the end of Bernanke's term, housing prices have begun to rise again. Look at that. That's in 2014. And GDP growth took a big hit in 2009, no doubt about that. And that's not like spectacular growth. Nobody would look at that and be like, oh, wow, the economy is like booming. No, but, moderate growth, modest growth. And so Bernanke, especially by many in the media, was portrayed as the hero. The hero. Look at that. Save the economy. Ben Bernanke saved the global economy, so why does everyone hate him? Not a bad headline. Pretty good headline. It's actually an interesting article. Both of these articles, you get... he was made Time Person of the Year. But a lot of critics said that he mishandled it leading up to the crisis, and that Bernanke had mishandled things by not allowing these reckless banks to go under, by essentially propping up the system. Okay, and then a lot of people were also critical about his quantitative easing and his low interest rates, saying, hey, he's going to create another bubble, or the value of the dollar is at risk. You can't have interest rates that low and not cause inflation. You can't have that much quantitative easing, as it's called, and not have a severe fall in the value of the dollar. Moreover, there were a lot of bank failures, but they weren't any of the big banks. They were smaller banks. And so small banks, community banks, suffered a lot during Bernanke's tenure. And concentration among the big five banks asset concentration went up. Look at that. By 2010, the top 5 banks controlled something close to 1/2 of all the bank assets in the United States. It's Jamie Dimon. Well, Bernanke leaves in 2014. Janet Yellen becomes Fed chair. Janet Yellen was president of president of the San Francisco Fed from 2004 to 2010. In a 2005 speech in San Francisco, Yellen had argued against deflating the housing bubble. She said, let's not mess with interest rates too much, and the housing bubble is not too big of a deal. She said the worst case scenario is that the housing bubble will be a, quote, bump in the road. That was in 2005. A bit wrong about that. She becomes Fed chair in 2014. Keeps interest rates very, very low throughout the first half of her term. But then in the second half, slowly begins raising rates again. Now, to keep in context, it's still just 1.5%. 1.5%. Historically, that's extremely low still. But it was a bit of an increase from Bernanke. Yeah, this is a long-term view. So here's Yellen from this point onward. Here's Bernanke. Okay. And under Yellen's term, look at the stock market, right? Through 2017, quite a lot of gains there. GDP, all right. Inflation, under control. Through 2017 through 2018, under 3%. Under 3% inflation. Gold price, look at the gold price. Went down after 2013. Those warnings of inflation didn't turn out to be correct. Gold was still over $1,000 an ounce, but didn't exceed really $1,300 an ounce. Now, compared to what it used to be, $35 an ounce, that's a lot, but a bit of a fall from the peak. In 2018, Jerome Powell became the new Fed chair, nominated by Donald Trump. And they've had a bit of a testy relationship. Jerome Powell, by the way, was, before he joined the Fed, and he actually joined the Board of Governors in 2012, he was nominated to be chair by Trump in November 2017. Before he joined the Fed, he was vice president at Dillon Read and Company, which was an investment bank. He also was a partner at the Carlyle Group, which was another investment bank. Powell, and this is where him and Trump got into a bit of a public beef. Powell gradually raising rates, right? Now this is Powell takes over around here. So this is Yellen. This is Yellen's raising of rates, and then Powell. And Powell is raising rates pretty consistently through 2018. And Trump was very, very, very critical of this. Telling Powell, hey, it's time to lower rates. We need to lower rates. And caused quite a controversy about the role between the president and the Fed chairman that I shall not go into. Here's the Dow Jones, and you look at it just going up, 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 flirting with 30,000 average. There's home prices. Look at that. We're back right where we were in 2006. Gotta wonder, is that a bubble? Is that a bubble? Or is that real? It's hard to tell a bubble. It's hard to know when you're in a bubble. All right? It's easier in hindsight. But is that a bubble? And what was that? That was the coronavirus panic. The coronavirus panic of 2020. Complete bottoming out because of the of worries about the virus from Wuhan, China. Stock market fell pretty rapidly from a peak of almost 29,000 points to 22,000 points. Pretty scary time, obviously. Look at the unemployment rate, just shot up from under 5% to almost 15% unemployment. In the second quarter of 2020, GDP fell by 33%. 33% fall in GDP. Just never seen anything like it. Now, to be fair, in the third quarter, it went up about that much. So it's been a wild year in 2020. Look at how Powell responded. Usually the Fed, now this is the target rate, okay? It's the upper limit, the target rate, because the Fed will set rates and they'll do a range. 0 to 0.25% is what it currently is, see? This is the upper limit. Usually the Fed will change it by about 0.25%. Look at it here, just complete drop. Very, very rapid, unprecedented action by the Fed. And the Fed, to prevent liquidation, just bought up all these assets. Now look at this. This is total assets of the Federal Reserve system. So how much assets owned by the Federal Reserve when the Federal Reserve in open market operations purchases assets, securities. Look at that. In early 2020, Fed went from $4.5 trillion worth of assets, which was historically very high, up to over $7 trillion in assets. We don't know what the impact of all of this is going to be between the super low interest rates, because honestly, this needed to happen. Interest rates were too low. Now we're back down to 0.25. And look at this balance sheet of the Federal Reserve. We've never seen anything like this. The Dow Jones recovered. We're at 30,000 now. Okay. But there's still real questions. Here's a more zoomed in graph of the long-term health of the economy. The unemployment, here's what happened to unemployment. Shot up, and now it's been back down again, under 7%. There's GDP in the third quarter. So pretty big rebound. Still for the year, because of the first quarter, still GDP was down about 6% this year. Gold price now exceeded at $1,200 an ounce. But gold has gone up significantly. Look at gold at the beginning of 2020, $1,600 an ounce. And now between $1,800 and $2,000 an ounce. Yeah, so those interest rates. Here's a long-term look at the federal funds rate. This is from the early 90s, okay, to 2020. So this really is unprecedented. Just never seen anything like this. These long-term low interest rates started to rise here, and then coronavirus came and just knocked it out. But so currently, purchasing power of the dollar. A good that cost $1 in 1945 now costs almost $15. Okay. If you compare 2020 to 2000, that's a big difference too. 1447 to 950. I remember in 2000 when I was in high school, my first job was at Chick-fil-A, and my wage was $5.25, and I remember the price of a number one combo, a chicken sandwich, large fry, and a soda, was $4.87. It's not $4.87 now. It's like $8 or something. Okay, that's not huge inflation, but it's noticeable. It is noticeable inflation. So we have had inflation in this early 21st century. Nevertheless, as it currently stands through 2017, the U.S. dollar is still the majority reserve currency around the world. You have the euro, the pound sterling, the yen, but the U.S. dollar is still dominant. We'll see how long that lasts. I have real questions about this, the Fed's balance sheet and these low interest rates. It will be interesting to see what happens to the U.S. dollar in the 2020s. Maybe I'll make a video about it in 10 years. We'll see. But anyway, I know this was a long video. Okay, there was a lot to talk about. But I hope you enjoyed it. Maybe in the description I'll make a little timestamp so people can skip to different sections. But very good. I'm going to record part C tomorrow. It's getting late in the day. I need to go home. But I'll record part C tomorrow. I think you'll really like it. Just be a bit of a look at the trends since 1971 in the financial industry and in the U.S. economy. So we'll take a look at that. Until then, God bless, and thanks for watching. Bye.